You're listening to Ron Siegel's Home and Finance Radio Show, only on Financial News and Talk. Now live in studio, your host, local and national real estate expert and consumer advocate, Ron Siegel.
And hello again. Welcome to Ron Siegel Radio. This is the show with no real boundaries as we discuss current events, financial markets, politics, sports, even poking fun at the rest of the media. This is the show that connects the dots of confusion delivered by conflicting media reports. We connect the dots so you know the actions you can take, how your family or business can benefit from current events. Most of all, thank you for joining me. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day. We have a very focused show. We only chat about items that affect the roof of your head, your bank account, and anything I feel would benefit you. But before we get into our intriguing content today, please join me in welcoming our featured guest, repeat offender on Ron Siegel Radio. Todd Ballenger is with us. He is a certified liability advisor and the founder of Borrow Smart University. Welcome.
Hey, thanks for having me.
Glad to have you with us. And let me remind you, if you ever have any home or finance-related questions, I am the consumer advocate looking out for you. And you can reach out to me directly, 800-306-1990, 800-306-1990, or ronsiegelradio.com. Just remember, that's the number you call anytime for assistance. When you call that number, it comes directly to me first. There are operators standing by.
Quiet, numbskulls, I'm broadcasting.
While we do have a great team when it comes to developing a financing plan, a plan to save you money, I personally work with you. Even if you don't have any needs today, save this number in your phone for future reference, 800-306-1990, 800-306-1990. And yes, of course, we're celebrating today. We celebrate every day on Ron Siegel Radio. It's National Truffle Day. Yeah. Well, you know, wait, Josh, I think I looked up truffles, and you're looking up, I was confused by them. So you've got the real truffles. That's like a mushroomy thing. When I looked at the picture on the celebration day, it was candy. So I don't know. I've beaten anorexia, so I'm going to go with the candy version. It's just easier for me. Let's take a look and see what the markets are doing today. Being that we're not going to be dealing with candy anymore, I guess I get overruled by Josh. We know that. Let's see what the Dow Jones Industrial Average is up 177 points. The S&P 500 is up 22.64. The NASDAQ is up 138. Oil down 50 cents a barrel. And the 10-year Treasury, it's down about 3.5 basis points. 4.6 is the yield on that. Do we even want to see what the gas prices are doing? I don't know if I want to, I'm just looking at these here. Okay, California, $5.38 a gallon of gasoline, $5.38. 367 is the national average. Todd, you're over there in North Carolina, aren't you?
Yes, sir.
$3.38 a gallon. Is that about right?
Yeah, it's a steal here.
Yeah, $2 cheaper than what we're paying. Okay. I'm going to stop crying in my milk right now. Hey, we've got a question of the day. So if you're watching us either live or on replay, we want to know the question of the day. Would you rather lounge by the pool or on the beach? So I was sharing this earlier with a group, and the question is, would you rather lounge by the pool or on the beach? And I said, if I have my choice, it would be the Hyatt Regency in Maui, because the pool there, if you lie on your back in a big area of the pool, if you lie on your back, you're on concrete and you get to see the pool. Flip over or turn around and you're staring at the Pacific Ocean. So my choice is just go to the Hyatt Regency in Maui so I get both. And one of the few times I sit on the fence. So would you rather lounge by the pool or on the beach? That's the question. What's your choice there, Todd?
Man, I got to add a choice. Can I add sit by the lake?
Okay, there we go.
Because I love the beach, but it depends. You got to have the right setup at the beach to really chill, and same with the pool. But something about the lake to me, the water, cool off, easy to set up, cooler, umbrella.
Well, cooler depends. That's a depending one, because when my kids were younger, we used to go to Lake Havasu, and between May and September, I think at night it gets down to 100. Although they tell me it's dry heat. So I guess I don't know what that means is dry heat. because I'm still sweating my tail off. Well, not literally, but hey, put that in the chat if you're watching the replays or later in the day. Put that in there if you're watching us or listening to us live on ABC News and Talk later. Send me a text or put it on any one of our social channels and give us an idea of your selection. Do you like the ocean or the beach? What's your preference? Let's take a look and see what's going on in the world today. I do have a individual I've been following a lot lately and getting a lot of financial guidance from. And brilliant lady. And I really enjoy the information that I get from her because, well, maybe it's because she's so smart. Danielle DiMartino Booth is the source of where I get a lot of information. And, she worked at the Federal Reserve 9 years as an insider. And she's talking about now a lot of the things that we've talked about on Ron Siegel Radio, but she's an insider, so she knows the facts behind my assumptions. And I've been sharing with you that the number coming out of the Bureau of Labor Statistics, that's the BS report, I call it. In fact, I should change that a little bit because it's BS reports, plural, because I don't think we're getting anything accurate out of there. And here's one of the latest issues that I'm coming up with or seeing. If we look at the first-time unemployment claims that comes out every Thursday morning, we talk about that on Ron Siegel Radio, but first-time unemployment, 208,000. Do you know what the first-time unemployment number was last week? Yeah, 208,000. Okay, now we've been running, other than the holiday weeks, 5 out of the last 7 weeks, the other 2 were holiday weeks. The number was 211 or 212,000 every single week. I think I have a better chance of winning the lottery than that happening without something going on there. Now, let's take a look at what the continuing claims are. 1.774 million continuing claims. That's people that have been on unemployment longer than the basic unemployment goes. Would it surprise you if I told you that the exact number was last week? Now, what is the likelihood of these numbers being exact over and over and over again? Not very likely, but and then we're going to get the jobs report or the big jobs report tomorrow. Do you think we can count on any accuracy in that report? They've been off so far. They're off about 15% every single week. 15%. How do we know that? Because they do the revisions. And now we find out Q3 2023. If you look at the numbers, the jobs report, they said we gained over 600,000 jobs. But wait, now we've got the revision in for the quarter, and they say we've lost 163,000 jobs. So not only didn't we gain jobs, but we lost jobs. Now we look, new orders and inventory issues. Decline in new orders fell from 49.1 to 49.1 from 51.4. Highlights ongoing challenges in the manufacturing sector. Inventory levels are also compressing, which could lead to further instability in order fulfillment. And employment trends, again, from Danielle DiMartino Booth. Manufacturing employment has stagnated with no significant changes in factory headcount over the past 6 months. Credit conditions are worsening. We've talked about that, evidenced by a sharp decline in credit managers' index. Index fell dramatically, suggesting that businesses are struggling to manage their finances amidst rising inflation and potentially higher long-term interest rates. Looking forward, the data suggests continued challenges for manufacturing orders influenced by an oversupply in customer inventories and tighter credit decisions. Okay, credit conditions there. Okay, so not as good as we were thinking in all these different financial reports. And when we come back in the Mortgage Minute, I'm going to talk to you a little bit about what the Federal Reserve had to say. But I did share with you, we've been talking a lot recently about my favorite new loan program. It's the Home Select program from Geneva Financial. And I love this program because there's a lot of issues in there that we're going to talk to Todd Ballenger about. He's an expert in this program. Billions of dollars originated in this over the years, helped bring it to market, in fact. But I don't know if it's ever been talked about using it. What if you lose your job? Right? Because where do we store most of our net worth? What if you lose your job? Could you use this program in that case? We're going to talk to Todd Ballenger about that. You're listening to Ron Siegel Radio, discussing your real estate current events and the financial markets. What's going on with mortgage rates? We'll talk about that. And we're going to feature the Home Select program from Geneva Financial. You can reach me anytime or off air. Number 800-306-1990, 800-306-1990, or ronsiegelradio.com. Facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube. Ron Siegel, the numeral 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio, your home and mortgage connection.
Confused about the home buying process? Or curious how much you really know about buying a home? Take the First Home IQ quiz to test your understanding of buying a home. Created by the nonprofit First Home IQ, this 5-minute quiz will give you a score, what you missed, and why. Take the quiz in 5 minutes at rsrlinks.com/FHIQ and find out what you need to know about buying your first home. That's rsrlinks.com/FHIQ.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. The Mortgage Minute today being brought to you by our friends at Geneva Financial when you're ready for that next home loan. Geneva's got the programs and the products. You just need to make a call, 800-306-1990, 800-306-1990. And every day at this time, OBMMI, they provide the most comprehensive, accurate, timely, and interactive analysis of pricing ever conducted in the mortgage industry, calculated from actual locked rates, with consumers across 35% of all mortgage transactions nationwide. What did loans do yesterday? Let's take a look at it. 30-year conforming down 7.225. 30-year jumbo was up 7.42. 30-year FHA down 6.866. 30-year USDA. Rural areas, generally no down payment, 6.92. That was up. And the best loan on the market for those that earned it, and we thank them every day, it's our veterans, the 30-year VA loan, 6.782. Remember, OBMMI does not give us APR, points paid, points received. They give us the number that you put into your mortgage calculator when you want to know what your payment's going to be. If you want to know what our thoughts are on the mortgage world every day, as early as the data allows, rsrmarketminute.com, rsrmarketminute.com. It is a free report that we send out. Let's see what's going on today in the world of finance and in the world of mortgages. Well, the S&P 500 is now up 16.62. We've talked about that one already. Let's take a look and see. The 10-year Treasury is, if my screen will refresh here. It's a little slow this morning like me. Okay, come on, computer. Well, maybe we'll have to go back and look at the 10-year Treasury on the other screen here. 10-year Treasury is down again about 3.5 basis points. This is the yield. 4.603 is where the yield is. 4.603. We're looking at mortgage-backed securities. This is the bond. When bonds go up, rates go down and vice versa. It's mathematics. It's at 22 basis points up is where we're looking at the bond at right now. 22 basis points up for that bond. And let's take a look and see why this is happening. Well, it all has to do, we've told you all week that the two things that were going to matter this week was going to be, what did the Federal Reserve say yesterday? And what does the jobs report say tomorrow? And the Federal Reserve, well, they left rates unchanged. We knew that was going to happen. They're still between 5.25 and 5.5. Although the reporters there, over and over again, I counted at least 4 times they asked the chairman afterward in the question and answer session, what does it look like for raising interest rates? And he basically said, we're not raising interest rates. That's not on our radar right now. What's going to lower interest rates? Well, he talked a lot about the idea that it's inflation that's going to lower interest rates. We're at around 3%. They want it to be at 2%. Not going to happen. We've talked to you about that because shelter and auto insurance are covering about 90% of the inflation rate right now based on their core number that they use. And again, core is those people that don't need food or energy. I don't know who those are, but that's the numbers that they look at. But the chairman did say they're looking at the extra data that I share with you from Danielle DiMartino, and they're not only looking at the inflation numbers. One of the things they're looking at is employment. And regardless of what we get from the BS report, we know from people, from your neighbors, my neighbors, people are having more and more trouble in the job world. So that's part of the issues right there. And I told you earlier about the initial jobless claims, which to me, I don't know if you can even pay any attention to those numbers, just because they can't be the same every week when you've got 50 states and you've got 360 million people, 3,007 counties, and the number doesn't change at all. Is there any possibility of that? And then you've got in their labor report tomorrow, they model it, and they've been coming out telling us that they've got all kinds of new jobs in the small business sector. Yet we look at the ADP report, and it said there was only 38,000 jobs created. A couple months ago, they said it was about the same in the ADP report, and over 170,000 jobs were in the BLS report. So we have to look at the headlines because that's what drives the market. But eventually the headlines are going to get caught up. I heard one person make a comment, and I don't know whether it's so or not, but do you think Jerome Powell is kind of slapping the president around a little bit for not renominating him as soon as he probably should have? I don't know if that's the case or not. That's the Mortgage Minute, brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva's got the programs and the products. Give me a call, 800-306-1990, 800-306-1990. Today, we are very, very privileged. We're joined by Todd Ballenger, a financial guru and innovator in mortgage and real estate finances. Todd, who has a rich history of developing cutting-edge financial products and training top-tier financial advisors, is going to share how integrating sophisticated financial planning tools can elevate client service and financial outcomes. Welcome, Todd Ballenger. How are you today?
Hey, I'm doing great, Ron. Thanks for having me.
I appreciate you joining us and helping us understand this very, very unique loan program. And I've been talking a lot about this program, and I know it because, I started looking at this back in 2007. It had a different name, but maybe you can walk us through the history of what we now call the Home Select program.
Oh, man, I'd love to. If I go back a little in time, I actually got my start in the financial services industry as a financial advisor. And I was fascinated with mortgage acceleration back when I first got into debt and looking at wealth creation. And, when you borrow money, you tend to pay back a multiple 2 to 3 times the amount you borrow because of the way the debt is structured, because of inefficiencies in the way that we repay. One simple example is if I asked you, Ron, how many weeks are in a month?
4 and a third.
Yeah, so 4 and a third. So you're crafty. A lot of people will say 4, and I'll say, how many months are there in a year?
12.
12. So what's 12 times 4?
48.
48. How many weeks are there in a year, though?
52. I think I'm getting some of these right.
Yeah, you're doing it. You're fantastic, man. You're good with math. So wait a minute. Why aren't we making 13 mortgage payments a year?
It's a good question.
Well, because if you did, the 30-year mortgage would not be a 30-year mortgage. It would pay off in 21 to 22 years. So there's some efficiencies out there that are kind of built in a way that for a lot of folks, I always like to just, again, ask simple questions. Why is it that we do certain things the way that we do them? And I was fascinated with how long it took. It takes almost 25 years to pay off the first half of a 30-year mortgage, depending on the interest rate. So a lot of people don't really pay that much attention to how they borrow, but they really pay even less attention to how they repay. They get into a note rate and they don't really think about it. Well, I was fascinated by this. So I started doing research on biweeklies and lump sums and mortgage repayment strategies. And I found this concept in Australia that was started by a bank called Macquarie. They were a large Australian bank. And their whole kind of foundational approach was that you have all this money sitting in your checking account that is not earning a return in most cases. And they had pioneered a different way to think about mortgage using really a checking account and equity line of credit. It's fascinated, went to Macquarie, worked with them for a while to try to bring that product to the United States. Virgin Money, Richard Branson brought it over here for a while, but then they decided not to continue it. And we'll talk more about the product that you've got access to now, but that was eventually a new product created for the United States, modeled after this Macquarie mortgage strategy. And it was just I thought it was a really novel and brilliant way to think about your mortgage in a completely different way. And it allows for some of those efficiencies or inefficiencies to be resolved. So I have literally played around with not only just mortgage lending, but this whole, how do you repay and borrow smart and repay smart, as we like to say, because it's the repay smart that really has the big impact on your cost of borrowing and debt over time. And one last kind of foundational concept for people to think about is most people think that a fixed rate mortgage is fixed, and it is on the contract. But if you get a 7% 30-year mortgage, right? The only way that you pay back 7% is if you pay the same payment for 360 consecutive months over the term of the contract. If you make any payment difference, like you pay an extra payment of $100 or you pay an extra payment of $1,000, your rate is no longer 7%, because effectively, right, you have now accelerated that note. It's a bond. So you actually have a great deal of control over your actual interest rates. You can literally pick the rate you want, and I can tell you how much extra a month you need to pay to have that rate over the life of your mortgage instead of the one that you start with. So people have control that they don't realize in many ways. If you say today the rate's 7, I could throw it in a spreadsheet and say, all right, but for an extra $200 a month, you're going to pay a 5% rate over the term of the loan, because you're not sticking with the note rate. It's there, but you have choice. It's a minimum, not a maximum, right? Unless there's a prepayment penalty, which in most states that's been precluded, the note rate that you get when you close on a mortgage is your minimum required payment. But the second you pay more, you're actually changing the note rate itself for or I should say the effective rate. The note rate's not changing. The effective rate that you're borrowing at is changing. And that's important to understand, because it's foundationally critical when you look at a product like the one we're going to talk about, where you're changing the way you repay the debt completely. And by doing that, you're changing the rate at which you're borrowing over time. And that's a powerful concept.
It's a fascinating concept, and most people have no clue about where we're going to head with this, Todd. And, to kind of piggyback on this, before we go to break, I'm just going to throw this one thought out. So one of the scenarios that I've got in front of me is a $400,000 purchase with a 10% down payment. And we compared it to a 7.25% interest rate. And the monthly payment was $24.55 a month, principal and interest. That's a minimum monthly payment. Again, Todd just shared that you can pay a little bit more than that. But if you follow this program that we're going to talk about today, would it surprise you to know that on this same 30-year loan, structured properly, the effective note rate comes out to 1.661? 1.661. We've got the examples right here at Ron Siegel Radio. You're listening to Ron Siegel Radio, discussing your real estate, current events, and the financial markets. When we come back, what's going on with mortgage rates, and continuing our conversation about the Home Select program. You can reach me anytime. Off-air number 800-306-1990, 800-306-1990, or ronsiegelradio.com, facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube. Ron Siegel, the number 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio. Your home and mortgage connection.
Hey there, friends. Wondering if now is the right time to buy a home? Or are you waiting for a bunch of foreclosures? The facts speak loud and clear. Defaults and foreclosures are down, sure. We might be headed towards a recession. But did you know interest rates typically drop and real estate values often go up during a recession? So what are you waiting for? Higher prices or higher payments? Don't navigate these waters alone. Connect with RonSiegelRadio.com today. That's RonSiegelRadio.com.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. The real-time real estate segment today being brought to you by rsrmoney.com, rsrmoney.com. What's going on with mortgage rates? You may have heard mortgage rates are going to stay a bit higher for longer than originally expected. And if you're wondering why, the answer lies in the latest economic data. Here's a quick overview of what's happening with mortgage rates and what experts say is ahead. Economic factors that impact mortgage rates when it comes to mortgage rates. Things like the job market, the pace of inflation, consumer spending, and geopolitical uncertainty and more all have an impact. Another factor at play is the Federal Reserve, the Fed, and its decisions on monetary policy. And that's what you may be hearing a lot about right now. Here's why. The Fed decided to start raising the Fed funds rate to try to slow down the economy and inflation in early 2022. That rate impacts how much it costs banks to borrow money from each other. It does not determine mortgage rates, but mortgage rates do respond when this happens. And that's when mortgage rates started to really climb. And while there's been a ton of headway seeing inflation come down since then, it still isn't back to where the Fed wants it to be, 2%. So we've got a graph, if you're watching us on RonSiegelRadio.tv, any of our socials with ABC News and Talk, AM 1490, FM 98.1 video feed, shows the spike in inflation in early 2022 and where we are now compared to the target. And you can see 3.5% now, they want us to be at 2%. As the graph shows, we're much closer to their goal of 2% inflation than we were in 2022, but we're not there yet. It's even inched up a hair over the last 3 months, and that's having an impact on the Fed's plans, as Sam Cotter, chief economist at Freddie Mac, explains, quote, strong incoming economic and inflation data has caused the market to reevaluate the path of monetary policy, leading to higher mortgage rates, unquote. Basically, long story short, inflation and its impact on the broader economy are going to be key moving forward, as Greg McBride, chief financial analyst, Bankrate, quote, it's a longer-term outlook for economic growth and inflation that have the greatest bearing on the level and direction of mortgage rates. Inflation, inflation, inflation. That's really the hub on the wheel, unquote. When will mortgage rates come down? Based on current market data, experts think inflation will be more under control, and we still may see the Fed lower Fed funds rate this year. It'll just be later than originally expected, as Mike Fratantoni, chief economist at Mortgage Bankers Association, said in response to the Federal Open Market Committee decision yesterday, quote, the FOMC did not change the federal funds rate target at its meeting, as incoming data regarding the strength of the economy and stubbornly high inflation have resulted in a shift in the timing of the first rate cut. We expect mortgage rates to drop later this year, but not as far or as fast we had previously predicted, unquote. In the simplest sense, what this says is that mortgage rates should still come down later this year, but timing can shift as new employment and economic data come in. Geopolitically, uncertainty remains and more. This is one of the reasons it's usually not a good strategy to try and time the market. An article in Bankrate gives buyers this advice, quote, trying to time the market is generally a bad idea. If buying a house is the right move for you now, don't stress about trends or economic outlooks, unquote. Got any questions? Give me a call, 800-306-1990, 800-306-1990. Continuing our conversation this morning, Todd Ballenger is with us. We're talking about the Home Select product and maybe a better way to take advantage of understanding. And that's what Todd's brought to a lot of us. I went through Todd's course, learned a tremendous amount through the Borrow Smart University. And even though I did my first loan, helped my first family with a loan back in 1983, I know many of you weren't born then, but the concept here is there's a lot of things that we don't think about because no one's ever shared ideas that are outside the box. So we're really happy that Todd's here sharing that, because most people think that, you got a 7% mortgage, that's going to be what you have to pay forever. Well, Todd just shared with us about that effective rate. If you missed that in the last segment, shame on you. But let's continue our conversation on this product, Todd, because this one really doesn't care what the Federal Reserve has to say, does it?
Nope. It might affect your starting point a little bit, but again, after that, it's really up to you.
And the irony is before the break, I had just thrown this tease out there about this one $400,000 loan, and I know it's not really the greatest product for California because we don't have too many $400,000 properties right in our area with a $1.1 million median home price. But you look at this and you start saying 1.776 is the effective rate, but the actual rate on the historic number, the initial rate, I should say, is 9%. And Todd, if we went out and started advertising a 9% mortgage rate, we'd probably get laughed out of the box, right?
Absolutely.
So explain how you would share with somebody on this product. Why does that 9% make sense when the market's at 7 or 7.25?
Well, as with all financial questions, every answer should start with "it depends," right?
Exactly.
It really depends on the person's situation. Obviously, the product we're talking about is unique in that you're paying interest on the net balance of the loan. So let's use like a real simple example for people that may not be familiar with this concept. Let's say you borrowed $100,000 at 9%, as you're saying, right? So in a traditional note, you'd have a term as well, like 30 years or whatever, and that would stretch that payment out, and you would figure out, okay, $100,000 at 9% for 30 years is this, and that's your minimum payment. With this product, the note rate of 9% is the interest rate that's being charged on the outstanding balance. So one of the basic principles is that most people have, let's just say, discretionary cash flow once they're paid. So let's say that you make $10,000 a month, you and your wife or partner, you guys have $10,000 coming on the first day of the month. It is rare that you would write a check on the first day of the month for $10,000 in expenses, right? Those expenses get paid out over the course of the month as you spend that money. So maybe on the 5th or the 10th of the month, I make my mortgage payment. Well, with this product, it can be made sort of automatically right from your account. But let's say that you have a car payment and some groceries and other things. And so over the course of that month, you're spending down that $10,000. And maybe at the end of the month, there's $1,000 left, right? So that's the way we behave. That's the way we kind of live our lives of cash flow. But what's happening is you're only being charged on the mortgage balance net. So if I had a $100,000 mortgage balance, but on the first of the month, I have $10,000 in my checking account, my mortgage balance net is $90,000, right? So right there, think about it. If my mortgage balance at 9% was going to be based on a $100,000 mortgage, if I put my payroll into that account at the first of the month, my mortgage balance just dropped to $90,000. That's like a 10% off coupon on your mortgage. So if I apply 10% off coupon on my mortgage of 9%, my interest rate just dropped to 8.1% effectively because I'm only paying 90% of my normal interest for that month because I'm only paying on 90% of the balance. Now, over the month, that account, let's just say, goes down as you spend it, and there's $1,000 left over. But then next month, another $10,000 comes in. And because there was $1,000 left over, there's now $11,000 in that account. So the next month, I get a 10.1% coupon off on my mortgage that I get to apply for that month. And I'm going to spend less interest than I would have spent. And my rate goes down now to, say, 8% on average. Now, each month I do that over the course of the mortgage, that coupon is getting bigger and bigger. The discount on that rate is getting bigger and bigger because I'm offsetting. The original concept was called the offset mortgage. That was what they called it in Australia, because Any money you have offsets your balance. So now, Ron, that's just if you have no extra money, you just have the normal lifestyle of money coming in and money going out. When people, we worked with Ameriprise and many different groups around this product to teach the concepts. Once they saw it, it felt like cheating, because then they would say, you know, I've got $12,000, let's just say for easy math, $10,000 in a savings account with my credit union, and it's earning 0.5%. What would happen if I took that $10,000 earning 0.5% a year and I put it into this checking account, this offset account? And I'm like, well, you're earning now 8% on that money, for one, but you just made a permanent coupon. You've got a permanent 10% off coupon on that mortgage now, as long as that money can sit in that account, because now your balance is $90,000 right off the gate. The net difference between your mortgage and that $10,000, it just sits in the checking account, but now you're being billed interest on $90,000. And when you put $10,000 at the first of the month and your payroll in, your balance drops to $80,000. And then it slowly increases as you spend that money. But you got 20% off that coupon rate of 9%. That's like 1.8% off, which is like 7.2%. So now people started to get creative. They started to think, wait a minute, I have other places where I have a little money here and a little money there. If I consolidate that, I'm going to drop my effective rate dramatically, and I'm going to pay the house off much faster. And, you know, what we can get into with some of the things that we saw people do that we learned from them, and they figured out ways to pay off their mortgages in 5 years, 8 years by using additional resources. We used to call it the Amish strategy. We had people that use it to help their kids buy their first house and be debt-free in 6 years. I can share with you how to do that. There's a lot of really cool strategies. There were about 10, 12 different strategies we developed using this product to literally feel like, man, I'm cheating the system now. I'm sticking it to the man. I am finding a way to become debt-free in an incredibly quick amount of time.
And we didn't even talk about the idea of having the liquidity there, because you still have the access to it. Second
Absolutely.
case study here before we go to break. Estimated home value, $800,000. Loan balance, $640,000. We still used a 7.25% interest rate. The mandatory loan payment, $4365.93. We're depositing $3,500 a week into the account. We're looking at this, and I want to get to we had 32% left over. Pays off in 7.5 years. 7.5 years is the payoff on this, with a 1.772 APR. And the other number that really, really excites me on this, when I look at this after 24 months, and we can, again, all these numbers are going to be available if you want them. Go to rsrhomeselect.com, rsrhomeselect.com. After 24 months under this financing strategy, principal balance is $515,923 versus under a traditional loan, it would be $627,000. So you're saving right there in the first 2 years over $110,000, or you're putting $110,000 in extra in equity. You're listening to Ron Siegel Radio, discussing your real estate, current events, and the financial markets. When we come back, more with Todd Ballenger and this program. You're not going to believe some of the things that Todd has to educate us on. We'll be back in just a few.
Ron Siegel Radio. Your home and mortgage connection.
79% of all credit reports have errors that should be corrected through factual disputing. You could be saving thousands every year if your report was accurate. CreditSanitizer.com provides a free credit report audit when you furnish a specific $1 credit report. You can use this information to request corrections to your report and potentially save thousands of dollars. Get your free credit audit at CreditSanitizer.com. That's CreditSanitizer.com for a free credit report audit. CreditSanitizer.com.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. Last case study I want to give you before we get back to Todd Ballenger. So here you say, okay, Ron, you did one at 400,000, you did an 800,000. Will this work if I've got a luxury home? Well, how about one that's estimated home value $2.5 million with a $2 million loan balance? The interest rate is going to be a little bit higher, let's say 7.5%. Mandatory loan payment every month, $13,984. Now, this individual is going to be making about $10,000 a week because you got to qualify for this. And they're going to have about 32% left over each month. Let's take a look at what this looks like. How about total saved on a 30-year loan? Total saved, $2,430,000. That's what's saved. The effective interest rate, even though the loan started with a 9% interest rate, the effective interest rate is 1.84%, 1.84%, and it's paid off in 7.9 years. Because we're talking with Todd Ballenger about how to do this the right way. Again, this is not for everybody. This loan is savvy individuals. Got to have some good credit. But that's just the idea right there. Let's continue our conversation with Todd Ballenger, chatting about the Home Select product. Again, you want all the details on this, rsrhomeselect.com, rsrhomeselect.com. So, Todd, you've got a lot of information in here. Is this, one of the things that we question all the time is, what are the financial advisors going to tell people about something like this?
Well, they have to know about it to even discuss it. And, we found that most financial advisors have very, very little training on mortgage debt other than to think, it's just a bad idea. If you can avoid it, right? That's sort of the party line. But they don't have a lot of experience with real estate apart from their own experience with home ownership. And for that reason, they leave a lot of the nuances of real estate wealth and borrowing and stuff out of the broader financial planning process. So when we were working very closely with large financial national firms, the first thing we had to do is explain to them why liability management was so important, why managing the way you borrow is as important as managing the way you save to build wealth. And then once we did that and we showed the concept, this particular concept is one of many that we would sort of explain to them, they really got the joke, as I like to say. And most people, when they hear this, and you should be skeptical because it sounds like magic, but there's no magic. It's just math, right? It's just compounding, math, time, and compounding is really, Einstein says the eighth wonder of the world. And the funny thing is compound works for you or against you. It works for you when you're saving and building wealth for the future. It works against you when you're borrowing and paying that interest yourself. So understanding how money and compounding works is important because then you can get sort of the laws of money, as I like to call them, working for you. Just like gravity works for you. It's a pain if you're on the roof and you fall off, but it's really helpful if I want to sit in my chair, right? Otherwise, I'd be floating around the room. So, understand the laws. They're not good or bad. They just are. And once financial advisors understood how this worked, they immediately became creative in saying, wow, I've got high net worth individuals that have enough cash sitting around to offset the mortgage completely. And this is a more advanced concept, but if you have, through your business, the ability to sweep and move money around, you can pay basically principal-only payments. And this is a mind blower for people. If you have a $400,000 mortgage and your mortgage payment, say, is $4,000 a month, you do the math. What's 400,000 divided by 4,000 is 100 payments. So 100 payments, that's 7 years to be debt-free. And how do I do that? Well, how do I pay principal only? Well, if you had enough discretionary cash or cash flow, you don't even need the cash. If you have cash flow, you could sweep money in from, say, a business account that you're not using that maybe you're required to have, sweep it over and then sweep it back. As long as it's not over a 30-day window. Most accountants don't even require that, you just cash management, but that cash can be swept in and out of accounts. You can use other resources to offset that mortgage so that you can pay it off as a principal only payment and then take those cash and redeploy it elsewhere. And someone may say, well, that's ridiculous. I can barely make my mortgage payment. Well, again, it works just making your normal payment with your normal cash flow. But when you have extra cash flow and you have extra cash or other investments that maybe even a CD paying 2%, wouldn't you rather earn 8% on it? Would take that CD. Yeah, take the CD earning 2%, put it in your offset account, and now it's earning an offset. It's offsetting 8% interest or 9% interest, which means it's earning 8 or 9% interest, and it allows you to then become debt-free much, much quicker. And as you said, the liquidity is really powerful. People have this cash and stuff lying around, but they don't want to put it into the mortgage because it's difficult to get out. They know they can't get the money out without selling the house or borrowing against the house, and that's expensive and time consuming. When it's set up the way it's set up with a line of credit, the way this product is structured, you can put money in, take it out, in, out every day with a checking account, with a debit card. It's incredibly liquid. And suddenly when that liquidity is there, you don't mind taking these other resources and using it there as a parking lot until you need that money.
That's a whole different concept as a place of just parking it where, your emergency fund, you need to have an emergency fund and it does nothing for you, especially if hopefully you don't have an emergency. But here it's doing a lot for you. Who's the ideal individual or family for this kind of a product?
Great question. Great question. So ideally, I was to say people that are serious about their money, for one, because people that don't really care about their money aren't going to take the time to learn how this works. And it takes someone like you providing a little education to explain the concept. But if they're serious about it and they realize that this is not a $1,000 kind of decision, like I'm going to buy a new TV today, to go to Walmart or here and I save $200 by going here. People will spend hours, right, debating Best Buy and Walmart and Amazon online. But yet, these are the kind of thing you spend an hour understanding this product and how it works. It could save you hundreds of thousands of dollars over time. So anyone that's serious about their money and has discretionary cash flow, doesn't have to be a lot. Again, doesn't have to be more than they're currently earning right now. But if you have a little extra cash here, savings in other places that's not being utilized, any extra cash flow, or even access to cash flow. This is the thing I'll leave you with. We would show people how the kids buy their first home with an offset product. The two parents, say from the two families, let's say it's a $400,000 house and they have discretionary cash and cash flow. Each family member puts in $200,000 into the account. You got it? I took $400,000 out of this offset to buy the house. But now the parents put in $200,000 each. Could be a wedding gift, could be anything like that. The kids now make the mortgage payment each month that they would have made because their balance now is zero. They make it to the parents. What they're doing is paying a principal only payment because the net interest is zero. I borrowed $400, but I have $400 in cash, so I have zero balance. If I have zero balance on a 9% mortgage, I pay zero interest. Now the kids pay $4,000 a month and 100 payments, they're debt free. And both parents have gotten 100% of their money back. So the parents aren't giving the kids a house, they're giving them a way to be debt free in 100 payments. And now the kids live the rest of their lives, if they're in that house with no payment. But should they buy a bigger house in the future, they're starting with a $400,000 paid off home that they can trade up to a bigger house and do the same thing again with an offset. So these concepts and strategies and ideas are ways that you start getting creative and you figure out ways to accomplish things for people that they never thought possible. So maybe you have someone that has money and you don't. They can use that money. We call it the Amish strategy, right? The Amish people would help people build a house. And these are fun ways. Yeah.
Awesome information. And just to throw some numbers, exactly what Todd was just saying, on our $400,000 example that we used with a $360,000 loan amount, following this particular strategy, again, starting with a 9% interest rate, you're saving $426,740 on by going with this strategy and having the home paid off in 7 years. It's just fascinating. If you want more information, give me a call at 800-306-1990, 800-306-1990. And if you are a lender listening to us and want more information about how to get in with Todd's Borrow Smart University, again, give me a call at 800-306-1990. I am a big proponent of the program. There's a lot there. It's a whole new way of thinking about mortgage planning. If you're transactional, it's probably not for you. If you're into helping people long term, it's a spectacular program. And again, give me a call at 800-306-1990. I am not a salesperson for Todd's program. I am a consumer of it just like you would be. But I like the idea. We started doing this radio show in 2010 to help people. And using Todd's program is a way of helping people. Todd, I really thank you for spending time. I know how busy you are. And I thank you for carving out an hour to help us out here and share this information. And as always, we ask, set that first radio preset button to come back here and join Ron Siegel Radio, where we only speak about items affecting your house and your bank account. Thanks to all of our sponsors. A big thanks to Josh and Sean who are engineering us today. And, of course, a special thanks to you for spending a little bit of your day with us. That's all for Ron Siegel Radio. Again, if you have any questions or to meet any of our guests, call me anytime, 800-306-1990, 800-306-1990 or ronsiegelradio.com. And remember, make a lot of money so you can help a lot of people and have a lot of fun. Have a great day. We'll talk to you next time on Ron Siegel Radio.
And older by the minute. My boss just put